This is a production of the Michael Parsons Trading Institute. All rights are reserved. Disclaimer required by the CFTC. If you risk it, you can lose it. ReversalMagic.com presents the Reversal Magic video course. The power to predict, the power to profit. Reversal Magic training video number 3. Understanding wave behavior. Reversal Magic is based on a method of wave analysis, that is, the triangulation of wave interactions. Your ability to identify wave patterns within the market will play a key role in improving the quality of reversal signals you obtain. So therefore, let's examine some aspects about waves and how Reversal Magic works with it in order to give you your signals. First, before you is a very simple wave pattern that's described in regard to amplitude and wavelength. Amplitude has to do with the height and depth that the wave develops, whereas wavelength, the time that it takes to get from one point to another, or the length of the wave. Let's break the wave down a little bit further and consider the crest and the trough. Now the crest, of course, is the height, trough, the depth of the wave, each of which is divided evenly by the equilibrium position, which is a center line that goes right between it. To understand this, imagine for a moment that this was a wave upon a sea. We would typically focus on the crest, but that exists developing the wave, but in between each crest would be a trough also, the depth of the wave. Did you know that those distances, if all was even out, the actual water level would be right dead in the center between the two, not favoring the height or the depth? This fact in regard to waves is important when it comes to determining signals, because what we're looking for are these swings, these wavelengths. Obviously, if you're out on a sea, the higher the crest as compared to the trough, the bigger the wave, the stronger it will be, and the greater impact it will have on anything it hits. The same thing is true in regard to a signal, in regard to the markets. The greater the distance between this crest and trough, the more likely you'll have a much stronger signal. Of course, a real market has many waves to deal with, not just one. And as they blend together, well, they can give the impression of a distorted, chaotic pattern, and yet still be based upon individual waves all blending together. For example, take in consideration this chart of these multiple waves. A market can be based on a similar situation, on multiple waves, a very large pattern wave followed by several smaller waves all out of sync. Now imagine when these actually blend together, the end result. The pattern, well, it can be rather unique, to say the least. And so this is true with a market that we may be trading. However, the reversals are based on the interaction of these waves, so we don't have to break down each of these individually to find a pattern. Even with this, we have the ability to take it and determine a reversal. The triangulation still remains the same, and that's what we're after. In the real world, or the real markets, the waves blend together to form a distinct individual pattern for the specific market. For example, on this chart here, which is of the British pound on the daily time frame, you may be able to note that there are wave patterns that exist, and you may be able to pick out individual waves themselves, even though they are blended with multiple waves. For example, you may note that there's a low to a high here, down back to a low, to a high, to a low, to a high, and so forth. And contained within this is still even smaller waves that go from a high to a low, high, low, and so on, back and forth. These swing patterns are what establish and help us to identify the wave patterns, and they are the focus of our attention in order to determine reversal signals. Granted, you're not going to be able to isolate every single individual wave within the market, but that's not really our focus anyway. Our focus is rather in the larger wave patterns that will in turn provide the stronger reversal signals. So isolating these in particular is what you want to be able to do, and that's where it becomes necessary to be able to determine these wave patterns. Now, if you have trouble determining these swings and these wave patterns, well, there's a few simple rules and tools that can be used to accomplish this. One is the simple trend line. Once a trend line is in place off of two lows, or if looking from the opposite direction, two highs, you can see a little easier the wave pattern that establishes itself. For example, right here you see a wave pattern as it bounces off of this trend line twice and moves away from it again. That wave pattern establishes how large it is, and so how far it exists away from the trend line is an indicator. The deeper it is, well, the stronger or the larger the wave pattern. But that's not the only thing that can be focused on. Another factor is simply the distance in price between each point. For example, how far is price from the first point, point A, to the second point, point B? Is it quite a distance in price, as this is? Then we know we have a stronger wave. Or if not there, between point B and point C. That distance, again, establishes how strong the wave pattern is. Now there are cases where you may have a very narrow distance between B and C, but a long distance between A and B. The fact is, if one side has a greater length or distance in price, well then you have a strong wave pattern. So these are two things that can be used. If we then triangulate our wave pattern, what we end up with is a very nice reversal signal here. If you look at it, the market had been in consolidation, and then at the reversal moved or broke higher, making a great profit opportunity for anyone who took that signal. But it's not surprising considering the size of the wave pattern that we're dealing with. If we compare that to a smaller wave pattern, what do we get? Well, looking at another wave pattern, perhaps this one right here, we end up with a signal that is less than spectacular. It is definitely a reversal signal, a low that established here, and the market did move higher, creating a small profit opportunity, but was very short-lived before dropping again within this consolidation. Obviously, there's a stark contrast, but that's obvious when you look at the size of the wave here, which is, although not too bad, does not compare with the much larger one that we see here. Quite a stark contrast. And of course, that can be seen in the reversal signal itself. This is not to say that just because a wave pattern is smaller, that it's insignificant. To the contrary, every wave pattern has a potential of providing a strong reversal signal. The key as a trader, though, is to be able to identify those patterns that clearly indicate that they're significant enough to actually trade, while avoiding those that are clearly insignificant. What are those characteristics we look for? Well, to summarize what we've already discussed in our prior pattern, there are three characteristics in particular we're looking for. One case has to do with the size of the pattern, as we see with this one. But a second has to do with a price change. Look how dramatic this price moves from this low to this high. And a third had to do with how far it drew away from the trend line, as we see here. Now most patterns will not have all three characteristics, but if they have one, and in particular two, you certainly want to pay attention to them. An example can be seen in this pattern right here. Now this is certainly not as large as a prior pattern, but you do see a dramatic draw from one point to another, price difference, as well as a significant move away from the trend line that would be established. When we triangulate this pattern, well, we end up with a reversal that is less significant. The result is a dramatic move from this point up higher. While not as strong as this reversal, well, certainly as a trader, it's one we would not want to miss. Compare that to another pattern that we may draw from this low to this low, creating reversal right here. The reversal here is rather insignificant. It does reverse, and we can see that from the price level change from this point to this point, for the time period it was rather dramatic. The depth of this pattern to the trend line is very shallow, indicating that it's a much weaker pattern or wave that we're looking at. If you look through the market, you will see many patterns that are clearly established as stronger wave patterns. For example, this from this low on up to this high, back down to this low. You see the depth in the period of time we're dealing with. How about this low to this high, back down to this low? Or perhaps this high down to this low, back up to this high. And we can go through in many patterns and find these significant V shapes that develop a strong wave pattern. These are the ones in particular you want to pay attention to. So if you're able to triangulate them using 1, 2, or even all 3 points, likely you're going to end up with a strong reversal, or at least a significant one, worth trading. An additional consideration when looking at waveforms is that specific market that you are actually trading, as well as the market condition at the time. Each market is different. It has its own personality. Some markets have relatively few wave patterns, and therefore the points that stand out giving you the most powerful reversal signals are pretty straightforward. Other markets are much more complex. They may have a dozen, 2 dozen, or more waveforms, and as a result the pattern is much more chaotic, making it quite a challenge to determine the strongest of reversals. An example of that is the Forex market, and we will be discussing the Forex market later on. But here before you is the market of the British pound against the US dollar, and you can see that it's pretty chaotic in the pattern that develops very sharp moves that are contrary to one another. Such is the case when you're dealing with a market with an extreme number of wave patterns. Despite the chaotic pattern, most of the pronounced price swings will depend greatly on just a few specific waves and their interaction with one another. In fact, even in this market, you can see that most of these highs and lows are spaced relatively close to one another in time. They do widen as time progresses, which is part of a wave dissipation that we'll discuss in just a moment. But still, the wave is the same one that we're dealing with. In fact, if you take a cycle indicator and you spread it across, you will find many of these waves, these highs and lows, in line with one another. Such establishes the fact that one single wave is predominantly impacting this market at this particular time. At this point, it would be good to talk about waves in general, where they come from, what happens to them over a period of time. The fact is that while some waves can be argued as being constantly within the market, the majority by far are caused by news events and reports that initially have a great impact on the market, but as time progresses start to fade and disappear. Some examples of this can be seen in the 30-year T-bond as we see in the market here. Here we see a report that came out, non-farm payroll, that was in reality less than half the expectation of the market. The result was a dramatic drop in the price level, even gapping twice. Later there was a Federal Reserve report that came out that was very positive, and the result from there was that the market rose up very sharply. These two waves created quite an impact and stir in the market, and they continued to create a wave that was quite long and swings that are very strong. But over a period of time you can see how these swings start to reduce further and further, and how far they move from one end to the other, thus making the point that the waves do dissipate over time. This means for us as traders that the analysis is an ongoing process. A wave that may impact the market at one time will in time itself become a thing of the past. The focus then has to become on the more recent activity and to use those waves to generate the reversals. A new wave will impact reversals, and we mentioned earlier that in rare cases that it will actually impact the accuracy. Now that is very rare, but it does occasionally happen. More often than not, the impact will be that a reversal, well, it's not quite the way you thought it would be, or the scenario is not quite as anticipated. To give an example of what I'm talking about, take a look at this negative PPI report. Now the 30-year T-bond tends to react very positively or move higher when there's a negative PPI report, and you can see how it did that. Now this was just before these other two reports that we mentioned a moment ago. Now we point this out because if we go back and look at the reversals we would have determined, I want you to note something. Let me shrink this down just a little bit. I'm going to go back and find a very large reversal point, series of points that we see right here. and here. Now these points, as you can see, they're large, and it's a large series of points, very deep off the trend line, and a number of other characteristics such as the difference in price is dramatic. So we have what we particularly want to focus on, all three elements that make for a good reversal. Now when we come back here, what do we find? Well, we do find it gives you a reversal right on time, right here. And the market does draw off it. But rather than a dramatic drop, as we would normally anticipate, along comes this negative PPI report and everything is changed. All bets are off. And the market, rather than dropping, turns around and goes the opposite direction. So the reversal didn't last long. The fact is that the negative PPI report made a dramatic difference. And, of course, when you're dealing with a new wave, this is the potential that exists in the market. So it's important to be aware of when these things come out, particularly if they dramatically impact the market. And right along with talking about wave generation and how it impacts the reversals is, of course, its dissipation, how it fades, and how that impacts the significance of the signals you have. Here is a market corn, and this makes a good example here of what the next point we want to talk about, because you notice how these swings are nice and strong and volatile. Yet as you progress down this downtrend, do you see how small they become, how much they fade into a point where it's almost as if they're non-existent. What remains is this larger wave that comes down and rises back up. But this other wave that's in here that's creating a bounce back and forth, well, soon disappears to nothing. And this is an example of how a wave dissipates. Now, how does that impact your reversals? Well, let's draw an example of a reversal off a signal and see what we come up with. Now, if we look at these points, we have a very deep pattern here, long ways off of the trend line. Price difference, very good, and also even the size is good. However, when we triangulate these points, what we end up with is, well, a very small reversal here. The market came down, reached an end, does one little final high before going one more drop. And yes, it did drop for a decent move, but it was gradual, slow. It was not anything near in comparison to the swings that you see up here, because the market had faded. These waves had dissipated over a period of time, so the impact they have becomes less and less and less. So obviously market wave dissipation is going to make an impact, but this is not such a difficult thing to understand or recognize. When a market starts having smaller and smaller swings, well, obviously your signals are not going to be as strong, in which case a trader can simply trade the market based on its momentum one way or the other. If it's rising, buy. If it's falling, sell. Unfortunately, most market conditions don't allow this type of motion. It is more likely to have swings like this. And this is the key area where the reversals will make a dramatic impact, when you have more volatility. At the same time, this is the type of market condition that is also the more potentially profitable. In any event, it's important to look at the market condition or the prevailing market condition and consider that when using the reversals. So a key here is the prevailing market condition. And how do you determine that? Well, it's an issue of volatility. Now, volatility we define as the amount of price movement within a given period of time as compared to another. In other words, it simply boils down to this. If you're looking at one single bar, and you have a bar this long, from a drop from this high to this low, and you're comparing with a bar over this area, and the longest you can find may be this bar, that only has this much movement, obviously this has greater volatility. But it doesn't have to be a single bar. It could be several bars, 5, 10, 15, 20, or whatever. For example, we may compare this swing here that we see from this high to this low, and compare it to the same amount of bars or time period over here. And what do we find? If we line up the number of bars, we don't see anywhere near as much of a price change as we do over here. Obviously then, this has greater volatility. By comparing the volatility within the market you're trading at different time periods, it enables you to know how to exploit the reversals. If a market is falling gradually like this is a pretty easy trade for anyone, even a beginner, to take advantage of. You just simply sell until it runs out of steam. But this is rare. You won't see this too often. In most cases, the market will be swinging like it did back here. In fact, very quickly, it returns to that state later on. And you can see how it swings back and forth in its rise as it did its fall just a little while ago. In any event, the reversals at this type of condition is a key that would provide you with the ability to trade it effectively, buying the lows and exiting out at the highs, making the best profit possible. So to summarize the obvious here, volatility impacts how dramatic the reversal signals will be. When we have low volatility, as we do here, where the swings are rather small and hardly noticeable, well, your reversal signals won't be much to look at. In a more volatile situation like we have here, where the swings are much wider and more pronounced, well, then the reversal signals will be rather dramatic. So obviously, these are the conditions that it's best to use the reversals. Finally, we need to discuss, in regard to wave development and behavior, the inverse. The inverse is where a wave actually flips over and changes direction. Rather than reversing the direction, it continues it. To show you an example of this, let's look at this market of orange juice. And we're going to triangulate a wave here of points that are fairly substantial. We should have quite a reversal off of these points. We triangulate it, what we end up with is this bar right here. Now, if you note, it's just a small bar with a similar open and close. Rather than reversing direction as we would anticipate, it instead had the market continue on it. What happened? Well, this is an inverse. This is where a wave pattern, rather than reaching a low, flipped over and it became a high, continuing the downward pattern. Inverses occur usually because a larger wave is forcing it to change direction. In order to compromise and to compensate for the larger wave pattern or movement, it must flip direction and adjust accordingly. To understand a little bit how this works, let's look at another chart example and see how an individual wave behaves when it runs up against a brick wall. If you have a wave moving toward a solid object and bounces off of that solid object, it doesn't simply return the same way it came. Imagine for a moment this wave traversing across a medium. When it actually hits a brick wall, what happens? It doesn't return the same way, but it flips over and returns below. A similar situation happens when our market waves hit a larger wave that has changed direction. It is forced to inverse or flip over because you have a much stronger, more powerful wave that's much like a brick wall to it, and it responds accordingly. In essence, this is what's happened here with our orange juice market. We reached a point where a larger wave forced a smaller wave to change direction and resulted in an inverse. To get an idea of how this works, let's expand this chart data a little bit more, and you can see that over a long period of time we have been in an uptrend, and this trend had recently broken. Obviously, a larger wave here that had been moving up had changed direction, and this is typical when you get an inverse. Something else is causing the market or the market wave to flip over and change direction. At first glance, this may appear to be rather scary. Here you're expecting a reversal, and it turns around and continues the same direction. Well, don't fret, it's not quite as it appears. First off, the odds of an inverse occurring are very small. In fact, in favorable conditions, the odds are 1 out of 7. So the odds are at least 7 to 1 that the market will reverse, not inverse, on a reversal signal. In conditions that are not favorable, well, the odds are even much less. So odds do favor a reversal. Secondly, there are specific conditions that develop to indicate that an inverse is likely. They do follow certain parameters. We discussed one a moment ago where we broke a trend line. The market's changing direction on a larger scale, and so a larger wave has changed direction and the smaller wave in turn is forced to inverse. Two other situations is that where you have a market trending very strongly, either higher or lower. And thirdly, the situation where a market is in a consolidation and it starts to break out of that consolidation. Those are the type of cases where you will see an inverse. Additionally, inverses will have specific characteristics that tend to give them away. They fall under three categories typically. That is the gap, the explosive move, and the doji bar, which is the more typical of the three. In fact, in this case of orange juice, we have a doji bar right here at a reversal signal. A doji bar is a terminology used in candlesticks to refer to a short bar with a similar open and close. There might be some variable there, but typically it's the same open as the close. And you can see that that's exactly what happened here. For a trader who sees this show up at a reversal signal, he knows that while a reversal still can take place, that he is at risk of an inverse. So what does he do? Well, he's going to set a position just below the low of that bar, so that if it continues lower, rather than remain in a buy position, he will flip his buy to a sell and take advantage of the continued move. This is typical what you want to do or be able to do if an inverse occurs. Now we'll talk about the explosive moves and the gap in a moment, but it's important to note that when you come to an inverse, what really is happening? As we mentioned before, the wave is actually flipping itself. So what does that mean? Well, it means this, that whatever distance it's come down to off of, where a low should have occurred and suddenly becomes a high because it's flipped, well, guess what? We can expect a similar distance down further. In essence, you see this as we take the prior high and bring it down to the halfway point as the reversal bar. What do you see? You see that the market proceeded down to this level, and as expectations, we can expect it, because of an inverse, to continue at least down to this level as well. Meaning that if you are able to flip your position, just as an inverse becomes obvious and clear, then you have the opportunity to make a substantial profit, and the losses remain minimal. Aside from the doji bar, inverse is also characterized by an explosive move or a gap. Now those two sound similar, but there are distinct differences that we're going to look at. The first is the explosive moves, and in this market of orange juice we have some good examples. Here is an example of an explosive move. You see how long this bar is. In fact, it even has a gap before it. But the key here is this long bar. When you compare that to the other activity of this market, you don't see anything that comes even close to that length and move. It's clearly an explosive move. Now what if you have a reversal on this bar? How do you interpret it? Well, if you've got an explosive move, what can you expect? Unless you have an extremely strong reversal signal, well, the odds are it's not going to change direction off an explosive move. Common sense. It's going to continue. At best, all it's going to do is pause the market. In reality, in a long bar like this, typically what you have is an inverse occurring, and the market, rather than reversing direction, continues on for a little bit longer. And that's exactly what we see here. Not only did it move to this level, but later on it continued even higher over here. Another version of the explosive move is the dual bar explosive move. An example can be seen right here, where you have two bars, and if you look at it, it ends up about the same length as we see over this bar, but the difference is it took two bars to get there. The characteristics of these two bars has a connection in that there's a slight overlap between the two, and that's typically what you will see when these dual bar explosive moves occur. Again, an inverse has occurred and it moves lower. Now, there was a reversal shortly following it, which is not uncommon, and that even occurred here in this explosive move, but still you're not going to look to buy at this point because the explosive move continues. The final characteristic of an inverse that we want to discuss is that of the gap. Now, while not all gaps are inverses, many inverses are in fact gaps. An example can be seen in this market when we triangulate a few points that we would expect to provide a substantial reversal, these 3 points here. What we end up with is this bar here. Now, whether you interpret this bar as a high or low, the fact is it's followed by a gap, and clearly something else has happened. In fact, sometimes you have the reversal signal on the bar following rather than the bar before, but in either case you're dealing with a gap. This is significant because it provides an inverse, and if you look at the wave pattern, it is in fact an inverse, because you can calculate a halfway point and see that just as the market moved up to that reversal signal, it continued higher the same distance, meaning that any trader who saw this and perhaps maybe even have shorted the market, once they see the gap, they would reverse their position to take advantage of the remaining amount or distance available in the wave move, and thereby turning what was a potential loss into a substantial profit. No matter what market you are trading, they all follow patterns of waves and their combinations as they blend together. The more you understand how waves work, the easier it is to understand and use reversal magic. Some markets will have just a few waves, and they're fairly simple. Some much more complex, but they all still follow the same principles. The more you understand how the waves operate, well, the better you'll be able to trade those markets effectively for profit. Reversal Magic Training Video number 3. Understanding Wave Behavior. This is a production of the Michael Parsons Trading Institute. All rights reserved.